Do you want to just spell out some of your thoughts there? Like, what if we're thinking about the Bitcoin protocol and what are the pieces of that should remain, right? What are those fundamental pieces that must remain?
Yeah, I mean, like, I would hate for someone to define me based upon one tweet response on one issue or 6 responses on 6 issues. I think that when we all start to understand each other's principles and philosophies and how we think about these things, I think it lays the framework for us to come to agreement or at least a constructive, cheerful consensus. So, starting with the basic on Bitcoin, and this is how I view it, right? Everybody has the ability and has the right to view Bitcoin through their own lens, and they have their own view of what is it for, and why are they attracted to it. So I'm not here to tell everybody else, what to think. I'm here just to articulate one view of Bitcoin that I've formed over the course of my life. And so I'd start with this observation. I'd say Bitcoin, it's an asset circulating on a network governed by a protocol based on or rooted in an ideology. And it provides humanity with a rational, scientifically sound economic foundation for the first time. So that's what Bitcoin means to me, right? It is a rational foundation for economics for the human race. And, Bitcoin with a small b is the asset. And we've created a digital asset, and we did it with the protocol. And the asset's no value. It is of no value unless there's a network for it to circulate on. So when I think about the protocol, this is the way I look at it. I think Bitcoin, it has 3 core protocols that are critical to the entire system working. The first protocol is a monetary protocol. The second protocol is a transaction protocol. And the third protocol is what I'm going to call a power protocol. It's near-term, real-time security. It's not security of the network over 100 years, but it's security over the network over 100 days or 100 minutes. It's the here and now. So that's based on power. Who has the power over the network? So when I think about Bitcoin in general, well, there's lots of Bitcoin nodes and Bitcoin applications out there. Anybody can create a version of Bitcoin that runs on an iPhone, an Android phone. It runs on Linux. It runs on a different type of computer, etc. For them to be part of the network, they kind of have to share these 3 protocols. They're going to differ in lots of other functions, right? There are other aspects of software. For example, compatibility. Is it compatible with this version of Unix? There's usability, right? Does it run on the iOS, and does it support touch or not? There's compliance. The version of a Bitcoin wallet that runs in the United States, by a publicly traded company, will have KYC AML restrictions for the state of New York, which will be dictated by New York and by the US. So there's differences in the software that have to do with compliance. There's going to be security differences, and this is cybersecurity. So there'll be lots of Bitcoin nodes, and they will all be different in different countries and different jurisdictions for different platforms. But the thing they all have to share in common is this common monetary protocol, transaction protocol, and power protocol. So the monetary protocol is the asymptotically approaching 21 million, right? There will never be more than 21 million. And there's been a lot of focus upon, the blocks of 50 and then 25 and then 12 and a half and 6.25 and the halvings, et cetera. But the truth is, I think about this not over the course of 10 years or the last 10 years. I'm not even sure the last 10 or 15 years matter, right? We're approaching the 15-year anniversary. But for the sake of our discussion, let's just say I accept Bitcoin as it is today, through all of its twists and turns, the block size wars, et cetera. And I look out over the next 100 years as my short time frame, and 1,000 years is a reasonable time frame. So I'm looking at this as is this a rational, scientific, economic framework for the human race for the next many, many centuries? Okay? And when you look at it like that, it's very clarifying and it's simplifying. For example, once you look out, 1,000 years, you're like, well, what is the monetary policy? It's 21 million. It's 21 million Bitcoin is the most it's ever going to be, and some of them will be lost. And that's the only thing you really need to understand about that. Someone wants to create a software program or a node that has a different policy than 21 million, they're breaking Bitcoin, right? They've corrupted the monetary protocol. And of course, you can have infinite monetary protocols. You could have 5% inflation a year. You could have 5 million Dogecoin a year. You could have all sorts of things if you wanted. You can create a crypto asset or a digital commodity that has a monetary protocol which is inflationary or inflationary for 100 years and stops, right? All sorts of things. But in this particular case, Bitcoin's monetary protocol has gotten to be very simple. We're around 19.5 million Bitcoin, but we're going to cap out at 21 million. So the truth is, to debate all of the nuances of how you get to 21 million is almost like second or third order at this point. Maybe it was second order for the last 4 years. It's becoming third order. It certainly is less than third order by 2035, when 99% of all the Bitcoin has been issued and you've got 1% to be issued over the next 100 plus years. You realize that 1% is divided by 100 years is pretty de minimis. So the monetary protocol is a hard cap scarcity. The transaction protocol is the 4 megabyte blocks every 10 minutes, which works out to, max, you're going to get to 7 transactions a second, or 7.5, 4,500 transactions in a block is pretty packed. And so when you work back into it, you think, well, like a slow network is 100 million transactions a year, and a fast full network is 200 million transactions a year. And the bandwidth is scarce, right? And the transaction protocol changed a little bit more over the last 15 years than the monetary protocol. The monetary protocol is pretty much pristine since, Satoshi defined it. The transaction protocol, jerked a little bit or adjusted with SegWit, and Taproot sort of adjusted because they changed the theoretical bandwidth and the theoretical nature of transactions. What kind of transactions will the network process, and how much bandwidth can it process? The third protocol is the power protocol. And in this particular case, it's not electrical power, it's computing power, but what kind of computer power? Digital power. You can define all sorts of power protocols to control a network. For example, democracy is a protocol. One person, one vote. Aristocracy, one rich family, one vote. Violence, one gun, one bullet, one vote. Right? The world's full of power protocols. The deer with the antlers have their power protocol. The power protocol for the Bitcoin network is SHA-256 hashing, right? And it could have been any other, right? It could be a proof of stake protocol. It could be all sorts of other interesting power protocols. But the question is, who at the end of the day gets to create the block every 10 minutes? And what kind of power do they have to project in order to create the block? And, if I had an algorithm which was a CPU-friendly algorithm, right? It's a non-GPU, a non-ASIC-friendly CPU. Well, then you're allowing any general-purpose computer to participate and generate that computing power. If you had an algorithm that didn't include computing power at all, it's just electricity. But of course, electricity isn't terribly scarce, and computing power isn't terribly scarce. So the idea of SHA-256 hashing creates a very unique digital power protocol. It's something where you can create custom silicon. So you have custom ASICs that are generating lots of SHA-256 hashes. And now we just crossed 500 exahash. That's a lot of power. But what's really critical, I think, about the power protocol is that it allows you to construct a silicon machine with a massive mechanical advantage. Like a custom ASIC, custom silicon gives you a 1,000x or 2,000x advantage over a general purpose CPU. And what that means is that what we have here is that 3 interacting protocols which create 4 types of scarcity. The first level of scarcity is asset scarcity. The second level of scarcity is bandwidth scarcity. There's a third type of scarcity, which is power scarcity. SHA-256 hashes are a very scarce form of power, right? They can only be created by Bitcoin mining equipment. And so there's a fourth type of scarcity, which is technical scarcity, technology scarcity. The ability to design, a high performance semiconductor chip that does SHA-256 hashing, right? What Bitmain has as a core competency, right? If you can create that. So in order to guarantee the asset scarcity, you have to have bandwidth scarcity. And in order to guarantee the bandwidth scarcity, you have to have power scarcity. And in order to guarantee the power scarcity, you need technology scarcity. And so you're really looking at like 4 harmonics or 4 types of scarcity, and they come together and they create a network that has integrity and efficiency, right? I need the efficiency. Like what's efficient? Here's an efficient power protocol. I have a gun. I'm in a room with 100 other people. One person with a gun that costs $300 has the ability to secure $1 billion in a room of 100 other people. It's a very efficient way to secure the money, right? Whoever has the gun. Now take away the gun, put the $1 billion in the middle of the room, and now your new power protocol is your fists. Now you can imagine, now you've got 20 people punching 30 other people, right? Now the outcome becomes very ineffective. Another power protocol is I'm going to secure the $1 billion with $100 million of staked money. You can see that the issue with that is in a staked economy, I have to actually allocate 10 or 20% of the capital to protect the rest of the capital. That doesn't scale very well. So when you actually get to the point where you're creating machines, whether it's a construction crane or whether it's a gun or whether it's a semiconductor chip, you have inserted know-how in order to channel energy, in order to actually exert power. And when I talk about, scarcity of power, well, the Bitcoin miners own all the SHA-256 ASIC chips. So, on any given day, if every power company or electricity company in the world wakes up and decides to attack the Bitcoin network, they can't really do it because the computing power, the digital power is scarce and they don't have it. If any government wants to attack the network, they can't do it because they don't have the power. The actual silicon machine is in the hands of the network operators. And so that creates a certain type of efficiency and stability. And you can't really build a civilization without it. I mean, it's the same kind of efficiency you get when you build a dam, right? You dam a lake and all of a sudden you're generating hydropower. Or the same efficiency you get when you have a construction crane and a 150-pound person can lift 20 tons in the air, 1,000 feet, right? It's clear you're not going to do it without having a machine. So I look at the entire network, and I think it's a pretty beautiful set of integrated protocols because the power protocol protects the transactions every 10 minutes. And the transactional protocol is a market-driven protocol where people are bidding to put their transactions into the block space. So as the ecosystem grows, the bid for transactions grows in a classic market economy fashion. And what you have is Austrian economics dictating which transactions will get implemented based upon subjective value of all the participants in the ecosystem. The miners over the course of 1,000 years, it's quite obvious, right? The miners are paid by transaction fees. The block rewards were a bootstrap or an initial subsidy in the first 20 years of the network. But as far as I can see, by the year 2035, the block rewards just look de minimis. So 1% of all the Bitcoin comes out over 100 years after that. So block rewards don't really matter. They fall away over the long time toward infinity. What matters is transaction revenues. And over time, I think we can expect the transaction revenues will grow to far outstrip the block rewards. And then if you look at Bitcoin miners, they're really Bitcoin power producers or digital power centers that are defending the network. They're the first line of defense in the network in the sense that anybody that wants to hack or interrupt the blocks in the next 10 minutes, they have to get through that hash wall. They're also the second line of defense of the network because the Bitcoin miners all have invested millions or tens of millions or 100 millions or billions of capital that they can't recoup in less than 4 to 8 years and perhaps longer in some cases. So because they have to recoup their capital investment, they form corporate entities in every single nation state and every jurisdiction, and then they become active, engaged lobbyists for pro-Bitcoin policies everywhere on Earth where they operate. So you really could think of the Bitcoin miners, kind of as all of the citadels on the wall that are defending what is Bitcoin, and they are in essence the defense arm of Bitcoin.